Unable to make this year's National Multifamily Housing Council meeting out in Las Vegas, which it's the biggest multifamily meeting of the year. The top owners, lenders, brokers are all in the same place, and everyone's getting the down low, the scuttlebutt on what's going on in the multifamily market. If you were unable to be there, don't worry, I was there. I'm going to download all of the key takeaways and what the conversations were on the ground in Las Vegas. But another slate of excellent research, reports, articles covering the multifamily industry, commercial real estate, and the economy. First section is a Groundhog Day this year. The groundhog came out, he saw a shadow. Does that mean we've got a longer winter in store for the multifamily industry? I mean, we've got higher interest rates. They said, survive till 25. Now, is it persist till 26, or you're just sick of the puns and analogies? And then disruptions and uncertainties from TREP. Office of Multifamily Loans have drove CMBS delinquencies higher, even higher. And then from Realtor.com, Trump pauses harsh new tariffs on Canada and Mexico. What does this mean for home building? What does this mean for supply in the coming years? And then finally, we're talking about real progress. From Marcus and Millichap, will CRV investors adapt to higher interest rates? Well, if they can't, that means you're probably going to be out of the game, at least right now. And from Globe Street, we got CRE deal volume. It's rebounding as price declines stabilize. Well, we know it's still volatile. Rates are all over the place. But if you are a multifamily investor, active or passive, you're not going to want to miss this episode. So make sure you tune in, subscribe to the Great Capital YouTube channel, give this video a like, and leave a comment. Let us know if we are right, wrong, or you're just indifferent to what we're doing. Stick around. Great episode. Dr. Matt Bosnagel is in the house. He's got a great episode for us. Let's get into it. Welcome back to the Gray Report. Matt, how's it going?
Pretty good. I'm excited to hear what happened at NMHC. We've heard it mediated through different AIs, and I'm looking forward to seeing what the human Spencer thinks. Although I did think that when you ran it through DeepSeek, it was a little more detailed than ChatGPT.
I was having fun, and I'll just give you a little inside baseball of what was going on. So I was at the National Multifamily Housing Council, and at NMHC. It's a meeting. There's meetings within meetings within meetings. It's like multifamily and conference inception. Yeah.
Is NMHC the biggest, or is there a NAIP or National Apartment Association?
The apartment association has their own conference. There's a lot of big conferences.
Okay.
NMHC is I don't know exactly the numbers of the people attending, but it certainly is the big show.
Okay.
And the folks that are there it's different from other. I've been to a lot of different conferences. NMHC, there's no real trade show. So it's not a lot of vendors. It's not learning about multifamily. It's not necessarily multifamily like retail investors meeting, sponsors. I'm not going there to raise capital, although you can raise capital. Typically for more institutional groups.
Okay.
It's where owners, brokers, and lenders. Those are really the three big groups, and it's the biggest of the country.
Okay.
You've got your gray stars that are managing like 200,000 apartment units. You've got all the nation's largest brokerage shops and all of their directors and their leadership. And then NMHC does a lot of lobbying work as well. They have a PAC that goes to Capitol Hill. They hire lobbyists and advocate for housing policy and housing reform. A lot of we've covered their letters multiple times here on the Gray Report. So, and then inside just this large annual meeting, and of course they have actual meetings for NMHC. There's political action meetings. There's operations meetings, and they also host. It's called the Strategies Conference, and so it's a one-day event. Whereas NMHC is about like 4 days in total. One day is the Strategies Conference.
Okay.
It's like 6 hours long, and it's all about really what we talk about on a daily basis. And so I was really daily basis. We're on the show once a week. What are the latest trends? Talking about the markets, operations, politics, and not everyone goes to that because they're busy doing one-on-one meetings, which is the primary purpose. But I like to push my meetings off for Wednesday, mostly Wednesday, a little bit Thursday, and I try to focus on the Strategies Conference.
Yep.
And I like to take a lot of notes and to try to bring those notes back because it's some of the top economists, folks that we interview on the Gray Report, but it's also some of the big owners, and just getting what their perspective is from different geographies, not just in the Midwest, not just the Sun Belt, all over the place. And so I was sitting there taking notes, trying to take as fast as I could, like I've done in the past.
Yeah.
And then, I had my iPad with me, and I had just downloaded DeepSeek because this was like the week after the volatility in the market as kind of the DeepSeek's model came out and sort of disrupting ChatGPT, and NVIDIA's stock price was, cratering.
Yeah.
And I was like, I got to just check this thing out because I like using ChatGPT as a useful tool and to play around with. But first I started with ChatGPT, and I just turned on the recording feature where it just records audio. And I was sitting kind of pretty close to the back, and I just let it go. And I record 10 minutes at a time while I took my own notes and listened. And then
It records and it automatically transcribes?
it records and transcribes. And so I would basically just dump the transcription into ChatGPT to summarize. And then I would also drop in my notes as well. And it would give a really good summary of the conversation. Really detailed and really nuanced. And then at the end of that, so I had basically all my notes to try to give a little bit more context and what I thought were key takeaways, which may have influenced the notes a little bit, or the output and the prompt. I took all of that information, all of the transcripts, all of my notes, and I dumped it all in the DeepSeek. After I had ChatGPT summarize, synthesize, and have an output. Everything from write me a memo for my team to summarize, as well as write me up a LinkedIn post. I dumped it all in the DeepSeek just to compare formatting. And I thought DeepSeek actually did a little bit of a better job of the analysis. But it was fascinating. You can check out those posts on LinkedIn. And I know you and Blake talked about some of the takeaways on the show last week, kind of almost in real time.
Yeah, we got the ChatGPT, not the DeepSeek one. But what was interesting though was that DeepSeek seemed to pull some more, pull some regional stuff that I don't think that ChatGPT touched on as much.
What I found was interesting. I made a comment on LinkedIn saying, and this was like as I'm there in the conference listening to everyone, and it's the same old story of talking about the Sun Belt, talking about gateway markets, which again, that's what a lot of investors are. That's what a lot of inventory is. So I know the audience is there, but as we cover this on a weekly basis, Matt, we know the Midwest and the Northeast have really been outperforming, and the Midwest has really been the true surpriser. It's been a sleeper for the last decade plus. And I started going to NMHC about 5 years ago, and I remember being amazed that almost no time was spent talking about the Midwest. And it's usually in the form of like mentioning Chicago, which Chicago's in the Midwest, but like Chicago's different from like the rest of the Midwest because there's no other like city like Chicago. It's a big city, different set of demand drivers, different types of demographics, et cetera. And so I thought this year, though, maybe there's going to be a little bit more highlight. And there certainly was relative to past years. It was mentioned, it was acknowledged, but it was like in the periphery. It was like on like the tail end of a conversation. But I dump all this into DeepSeek, and it picks out, even though the specific questions that were asked, the topics that were discussed were not all in the Midwest, it still pulled out that one of the big takeaways was opportunities in the Midwest specifically as a major takeaway. And a lot of the conversations that individuals with brokers and owners were of those saying, we're taking a look at the Midwest now, and people calling it essentially the new emerging market because of this shift of surging of jobs, of manufacturing renaissance that's going on, that whether it's batteries, solar panels, EVs, data centers.
Now, I heard data centers is like you just need one guy to run it, just turns it on and hooks the cables.
I think it's more than one guy, but it's not like hundreds of guys. Well, there's an article in the Indianapolis Business Journal that came out a couple of days ago that it was all about how Indiana is specifically set up to excel with data centers because we have the energy. We have excess energy production.
Okay.
I guess we have capacity to produce more energy, I guess. And we also have a ton of water. So like we've got all these natural resources that can support high energy use, high data use,
Yeah.
running all those GPUs, which is interesting because, again, just the Midwest, to a lot of coastal investors, has been written off as Rust Belt flyover country.
Yeah.
That, the factory and steel jobs all went out of business in the late 70s and 80s, and then they just never looked back to learn any more information about it.
Yeah, I have a hard time believing that someone would invest so much money for a data center and it not be a source of some jobs that are persistent, and maybe even jobs that we're not even factoring in right now.
So
like people, so what I've heard in the Reddit comments, the Indiana subreddit comments was, and they're obviously of a
really
certain
credible source.
Yeah, they're obviously of a certain bent, but I was kind of repeating their criticism was really, it's not really bringing in jobs. It's basically a giant warehouse full of computers. You need a guy to maybe fix it if they break, but it's not like they're building the computers there or anything like that.
True.
I think there's jobs we haven't thought about that are going to be involved in that. Maybe they center people here because there's a lot of millions of dollars that they need to be.
Somebody's got to fix the GPUs when they break down. But there are people that have to. Can perform maintenance on the building. But it's not thousands of jobs. I think the Meta's data center down in Jeffersonville, which is gonna the price tags on these things also. It's like they've estimated 1.3 to 2.8 or 3 billion. It's like, is it 1.5 billion to 3 billion? What's another billion amongst friends? But they're projecting to be 100 jobs.
Yeah.
So now, if it was a $2 billion facility of any other kind, you'd be thinking it would be thousands of jobs. So it's not one job, but it's not thousands of jobs. But those 100 jobs be relatively high paying, and then again, I think there's probably some ancillary services that are around that as well.
It's good news, I think, unless and there was the other argument was, does it mean that does it disrupt like water or does it make power more expensive? Would be another argument about data centers, and I don't know how that's going to happen. Let's hope for the best.
Well, and we're getting off topic, but
sorry.
it's I think it's one of these. It's a major AI. Getting back to data centers and just why AI was a topic throughout NMHC. Between just the ability to disrupt information. The economist was talking basically about how his job, in a lot of white collar jobs, are much more at risk. Due to, he's like, look, all I do is I take in information and I synthesize it and I explain it to people in an easy to understand way. And that's what all these large language models do also.
And supposedly one of the first ChatGPT AI agent things, they're beta testing their researcher agent. That's the first thing, is just getting a bunch of links. I think obviously there's a role for the human. I've said this a million times, is people don't talk to each other just to convey information. You want to connect with someone else, and there's always going to be that person that's connecting, and you always want to attach a piece of information, ideally to a human that's kind of responsible for it. So I think it's not a zero-sum game here.
No, there's a lot of norms that are gonna have to be kind of created and standards, and
all those ums and ahs and human imperfections.
Yeah,
that's what people like.
And I wonder if AI will be able to get all those imperfections correct, because without that, it starts to become so artificial. But no, there's going to be more value on authenticity, because I was thinking about this. I was putting these 10-page research documents together in 30 seconds, and so I had these two feelings. On one hand, I'm like, this is incredibly powerful. I did this while I'm paying attention in a seat at this conference. I can send it out to my team. I can post on social media. I can do marketing. It accelerates all that productivity, but I'm like, but I didn't feel nearly as satisfied as if I had actually written that 10-page report. It was like, I'm glad, this is great that we could put this together. I kind of have to read through it to make sure that it's actually accurate and it's not inferring things that I wasn't inferring, and reading the wrong things in between the lines. So I think there's going to be more authentic work is going to be more highly valued. And when I talk to artists, and I know this illustrator who he's very frustrated with AI, because he's like, I've lost 4 clients recently because people are just using AI, corporate clients. I'm like, but if you're really good at your craft, AI is going to be able to get pretty damn close. but there's a difference between like original painting and a print.
Yeah, and I think there's still
print looks like
yeah.
you can't tell
people
the difference.
People cared way back when what was it, like A Million Little Pieces or something when we found out that it wasn't real, but we love the story, but people care if it's real, and they're still gonna so that'll be an interesting thing that we'll see. But I'm more interested in if we want to bring this back to real estate, if we're researching stuff in real estate, I always got to kind of check the sources, whether it's whether it's a census or anything like that. So chase those sources down, and when you're when you're reading it, it does pay to dig in.
I see it it'll grab a real number but attribute to the wrong like actual data point.
Yeah.
And so what was I looking for? It was unemployment rate or something. I was like, help me. I'm doing write up on the economy. I just pull all the most recent like macro econ figures and GDP, unemployment, all this stuff. I'm like, this is great. Cite all the sources, and it has all the sources cited. Then I'm like, no, I'm like, nope, some of these are wrong.
Yeah.
And I clicked on the source, and I could see like here's the correct figure, and then a couple lines over, it took the number that it used. It was on for it attributed to something different, and I'm like, and I had to tell it, I'm like, recheck, like you're screwed up here. Try it again. But it's far from perfect, but still fascinating.
Yeah.
And it's obviously going to permeate through all industries.
So other than that, so there's like these like research and like talking to you and conveying this information. Did they ever talk about other forms of AI? And there are other AI. There's AI stuff that we use with like a RealPage or something. And it's what is it kind of thinking about
the multifamily industry and AI?
Yeah.
So a lot from a lot of different perspectives. So first, before we get into just the step of takeaway, which I think was really important, is that in all industries today, in multifamily, asset managers, property managers, owners, we're really quick to Band-Aid over solutions with a software fix. Because there's a million SaaS companies that are selling some solution, all targeted and focused on identifying a pain point in your business, and we've got this magic solution that's going to just fix it. And what we've seen happen is that sometimes it's like problems get layered over with solutions, and you buy one piece of software, you think that's going to fix the problem, and it fixes some of the problems, but not all of them, or it creates another problem. So you stack all the software, and the whole idea is at some point is to do it better or to do it cheaper. And if you're paying for all this software, it's not cheaper all of a sudden. And so where it was one of the best, I thought comments that I took home is that instead of trying to solve all your problems with another software fix or AI, like, AI will be able to do this for us. Like sometimes, like some of the problems are with people. People challenges.
The end user.
Or drive. You're trying to drive where costs are driven. A lot of it's like turnover, high turnover industry. And if we spent a little bit more time, and this isn't exactly answering your question, but if we spent a little bit more time,
it's relevant,
doing a better job recruiting, better job onboarding people, a better job training, and then giving a sense in helping them chart a path to success, and what the next steps in their career could be. Providing a little bit of hope for the future.
No,
we focused a little, like take a little bit of your budget on software, just focus on better onboarding and people stuff. You're going to be able to reduce a lot more expenses than a new Band-Aided tech
well, those
solution.
are the people that are using it, and you can have really expensive stuff if it's not used right. Then,
but I mean, in terms of how AI is being implemented into multifamily today, Nikki Tag, Gray Residential, she uses AI, and there's probably
she's generating text and generating pictures.
Generating text, she's generating images, so whether that's like it's internal communications, flyers. Some even like policies, and you have to review all of it. But
that's boilerplate though. That's not really like that kind of stuff. I feel like AI would be really good at the boilerplate kind of boring stuff, and
for example, we use it all the time or our team uses it all the time. How to respond to a resident. There's an issue, or you're trying to explain that we're changing the way we're charging for utilities. How do I say this in a nice way? And instead of like just banging your head against the wall for 30 minutes of trying to like wordsmith this email, you can say, this is what I've got. It's not perfect. Can you fix it for me? This is what I'm trying to accomplish.
Like conversations that you wouldn't have a whole lot, so you don't have a whole lot of practice in. That's interesting.
Yeah, and awkward conversations.
Yeah.
How do I word this email? Where do I start? And instead of working on it for 30 minutes, you can work on it for 10 minutes, and feel confident that like I've got something good here because like the AI is like is saying that it works, and I agree that it works, and I've given some input, so I feel like it's mine. It's not just completely canned. And it's quality in, quality out. But we're also, we're looking into some software on like the revenue management side that uses AI to better understand what our availability is, kind of what our occupancy is, what our past rent history is, to try to find kind of an optimized position in the markets using like anonymous data.
So much of that's like computers. I don't know where AI and machine learning.
Well, so a lot of it's a black box.
Yeah, and or like algorithm or whatever. You call it what you will. Like it is interesting. Things are getting. Sometimes I'd rather feed it through the computer than an AI, because maybe that rent growth that you're looking for is a little different. But I think it's interesting how much it is growing, but also like it's not taking over everything. So I was terrified when AI started that it was just going to take over everything. And I think that they're still trying to take us. The owners of the AI are still saying that it's going to take over. They want us to believe that, but more and more, I think people are learning to work with it.
Like a Project Stargate.
Yeah, exactly. Yeah.
So, well, I hear, speaking of NMHC, let's talk about some more apartment stuff. We got the quarterly survey of apartment conditions. Quarterly, they take a survey of how everyone's feeling.
Yeah. So I wanted to.
I don't want to jump ahead too far.
No. I think that this illustrates. This is the Groundhog Day. Really, the numbers behind the Groundhog Day that I was kind of thinking of, and it's a real turning point from the end of Q3 2024 into basically Q1 2025. Interest rate optimism dwindled, and in the deep recesses of the human heart, where resides the common threads of investor sentiment, a more hesitant and melancholy chord has sounded. Current sentiment on the multifamily market is down. I got a little romantic there, but these feelings really touched me, and it is a little disappointing that things have gone down. We're basically at where we were in terms of overall sentiment, I guess. A little improved from January 2024, but not much different if you're comparing January 2025 to January 24, especially when it comes to market tightness, which is a product of our renters filling up apartments, and then their sales volume. It's a little bit better. So investors are buying slightly more, but not by a lot. Equity financing, the same picture. It's hard to get investor money, relatively a little bit better since last year. And then finally, debt financing is a little bit worse, it seems like, compared to January 2024.
Yeah, I mean, it's not surprising. I mean, to me, the market tightness, we're not doing as good as maybe we were, or sentiment isn't as good as July. But we also, we should think about like where everyone's head was back in July and October, really back for July, because October, we were already getting a sense that, obviously the presidential election hadn't happened, but rates started, 10-year treasury started moving, with the idea of that maybe Trump is going to get elected, tariff business that we're going to talk about in a little bit. But it's tied to the debt financing. In July and October, there was a confident sense that the Federal Reserve would continue to lower the Fed funds rate, so we would have lower interest rates. The 10-year Treasury was sub 4. It was in the basically like 375 to 425 range. Now all of a sudden we're at, we got up to 477, and then we're closer to 4.5 today, or when I looked yesterday, and so the interest rate environment has changed considerably, and that affects sales, it affects volume, and it affects values. It affects refinances, it affects loan maturities. Individuals and owners who were hoping to transact this year, it affects the buyers. Because if you were wanting to buy, you need low interest rates to make the deal work. If you wanted to sell, you want to have lower interest rates so your buyer can pay you a price that makes sense for you and for them. If you've got a property that has a loan that's going to be maturing, or just a loan that you don't like, you'd like to refinance. Well, you need rates to be favorable to be able to do that in a way so you're not having to bring money to the table
Yeah.
when you actually close.
If you scroll down, you can see graphically how much things have fallen off, especially when it comes to debt and equity financing. There after this, So market tightness and sales volume, that seems to be okay. Obviously, sales volume has fallen from the previous quarter, but the chart below this that talks about equity and debt financing, you really see a drop off from the previous quarter.
Yeah, I mean, it makes sense. I mean, the debt is available. I mean, lenders want to lend. It's just the interest rates are high.
Yeah. Yeah.
So it's not as though that that debt is tight, not necessarily on terms, but just on costs.
And that, to me, seems to be the biggest question that I was thinking about this week.
And equity is equity is changed from October, but it's basically back where it was kind of mid last year in 2024. Where look, if we can find a good deal, we'll do it. But it's hard right now. Where people are getting excited.
Compare that from a long period from October 2022 to October 2023 when it was down in the 20s or the teens, and now we're back up to the 40s, the 50s, which is basically even, it seems like. No, I think that the big question here is, there's the steep drop off. We got really optimistic, and now we're just really not doing too well. Globe Street poses this question. We'll talk about this in a little bit, but and so does Marcus and Millichap actually more directly, is the fact that people are adjusting to maybe the expectation of higher interest rates, and that fell out of the NMHC meeting and conversations that John Chang had with people talking about the multifamily market specifically, about how maybe in the interest of actually transacting this year, they're willing to accept this idea that rates are going to be maybe in the 4.5% range throughout the entire year. I think that could happen. I think it's also intersecting with loan maturities.
The dream is gone.
Yeah. So
I mean that's what I was getting, is that that dream of, hey, no, we're very confident the rates are going to be lower next year. That's what everyone was saying last year. We feel strongly the rates are going to be much better. We thought that too. We're most likely rates are going to be a little bit lower next year.
So
because inflation is still receding. I mean, again, these tariffs haven't gone into effect, and we'll see what happens. It is more of the idea that there could be more inflation related to tariffs, which is a possibility, but it's not happening yet. If you look at the CPI print, I mean, if you strip housing out and you just look at the super core, I mean, we're kind of where we need to be. So
agreed.
We've talked about this in the last several weeks of how much is of the higher rates, and even the Fed going on pause, which they did last week. How much of this is just overcorrecting a little bit for a concern of the unknown and for volatility?
I completely agree. I think that there was some real strong signs of that inflation was kind of getting under control. The long-term trends were really positive, and even the jobs numbers didn't suggest that we would get close to like an overactive labor market like it used to. Jobs are down. Job growth is down from previous highs on the long term. And when you're talking about long term trends, so it's not exactly like we're like battening down the hatches and keeping the door shut before inflation blows in. Things are actually calmer outside than you think.
The one thing that I don't think about that much, because it's like there's so little I can do to control it. But the U.S. government we are paying a lot of money in terms of debt service. I mean, we were, issuing 10-year Treasury bonds at, 1%, in the pandemic, or at least, call it 2% to 3%. Our debt is considerably more expensive, and those interest payments are adding up, and that does add to the potential, risk for, the U.S. and would require a higher interest rate if people are. If bond holders and owners of U.S. Treasuries are less confident in the U.S.'s long-term fiscal position, they're going to demand a higher rate for that potential volatility down the road. And so that's where, the whole idea of, like Doge comes in, or like the idea of that if we could get our fiscal house in order to a degree, that in effect would lower interest rates, which also brings down inflation, and it'd be nice. But that's not, I don't think anything that's going to happen.
We talked about this,
None of
and
that's gonna happen.
and I thought about it a little bit afterwards, and he did run Twitter, and he got rid of all those people. Twitter's still functioning, but the valuation is a little different. It's a different product too, because it takes a whole lot of people to do the kind of moderation that Twitter used to do. And now,
now it's just community notes, right?
That's fine. No, but I think it's just like a difference. I don't think that it applies necessarily to the government, but we'll see what happens. He's got a good team.
He's got Rockies. He's got a space company though. That's complicated.
Yeah.
I don't know.
No.
I agree. And he's obviously a smart guy.
And
whether he knows anything about how like the government works.
And the more I kind of am looking at, I don't. Yeah. Oh no, I don't either. I don't think the people running the government know.
But did you hear what they did to all the employees got the fork in the road email?
Yeah, they got the same. Well, that's efficient, right? You clone that email, and then you just have.
I almost sent out to everybody
just like what
here.
we do on HubSpot. Yeah.
I almost sent to everybody here. But I was like, we don't have that. We don't have a big enough problem.
Yeah.
I don't have anything to be like, who's going to be hardcore enough?
It is funny that he did copy it. Like that is actually save energy. Why do you need to come up with a whole new email? It's the same. Yeah, just clone it. Copy paste.
I've got a template.
Yeah. But I think that also the more I kind of think about it, it's not quite so worrisome. Supposedly they only have read-only access, but I also think that
hear what they did at USAID?
Yeah, I know they're doing a lot. They're doing a lot of stuff, and I have to piece it together. And maybe if you want to move on to talk about the tariffs
too. Some
of
this is
because if we're talking about how like the real impacts on the economy, and this does tie into things that Elon Musk is doing, things that maybe Marco Rubio is doing now as the interim head of USAID. It is a messaging thing. It is part of an ongoing negotiation. They are being very clear about their intentions, but not maybe necessarily about like the tactics and specifics. And I think the tariffs are a part of a kind of not quite convoluted negotiation. It's all a negotiation.
I know you mentioned you wrote this in the notes, but I mean, what was it, 2 weeks ago? We basically said, look, he has to do something so everyone takes him seriously. Yeah. He has to actually do something so everyone's going to be like, oh, he's serious.
Yeah.
And everyone's going to freak out, and then they're going to undo it. And isn't that exactly what happened?
I know, but I wrote
like within the same day.
I wrote like, why?
Like we did tariffs, so he can tell everyone that he did tariffs. I did 25% tariffs, and it worked immediately because we didn't have to do tariffs.
And then there was some exchange of some kind of service or promise.
Yeah,
and then
Canada's gonna do something.
I heard that they were already going to do it, but I think that it doesn't. It kind of gives away the game. But then, like, it doesn't mean that he's gonna not do it to another country and not be serious.
Everyone knew the game beforehand.
Everyone knew exactly. Everyone. So that's what's kind of interesting, and that's why maybe I feel a little bit bad because using these tariffs as a bargaining chip means that you can't be clear or straightforward about what you're gonna do, and I like the idea of predictability. I don't want to be caught on the wrong side of any damages as a result of the brinksmanship that's happening. Because how long do you need to be? Does the next set of tariffs? Is he going to have to wait a week before making these deals? Like what? So it does create some uncertainty. So this is.
Well, I think that's part of the plan. I think that's all very intentional.
Mm-hmm.
Not sure what's real, what's not, who he's going to actually really lean on, and who he's just leaning on him for show.
And it may pay, and I think the Wall Street kind of took that signal too a couple days ago. It may be more worthwhile to just kind of operate like everything's normal, everything's going to be fine. Don't worry, keep moving, and not ignore him. Let's not ignore him. But maybe not. Maybe see it as a bargaining chip as anything else. But
yeah, I mean, big question. I mean, again, so how it affects multifamily, and that's where I take this stance of, again, understanding what's going on, but like how does it affect us? And the potential effect is on new prices of new construction.
Yeah.
Whether it's material cost, whether it's steel, whether it's lumber,
NAHB.
labor.
25%, they said, was what 25% of building materials imports rely on components produced abroad, and specifically Canada and Mexico. So this is the letter that NMHC, or not NMHC, I'm sorry, NAHB wrote to President Trump, and I don't know if that moved the needle, but maybe it was a factor.
I thought it was cute that you thought that.
But it wasn't the only organization. This was a signal that, and this is what we said too a few weeks ago, is these tariffs will only be in place as much as the negatives. If he gets any negative signals about impacts on the economy, then they're not going to be real. And maybe instead of blanket tariffs, he does pick and choose, but hopefully he doesn't pick and choose building materials like the ones that NAHB has noted.
Well, and it's interesting, because we're coming into an environment where construction is slowing down anyway, and so the demand for these goods is going to be slowing down, and so it would be very different from what compared to when the first time around when we had COVID, we had tariffs, and we had a housing boom, a huge housing demand. Not that we still need all these materials all the time, but the actual effects are more complicated to really calculate, because like one of the big items that Canada was going to impose tariffs on were vehicles. But you're not buying a car every day.
Yeah.
That's going to affect someone once every couple of years. So tariffs are, I'm like pretty hardcore free trade.
Yep.
And because I think that's the net positive for everyone in the United States and around the world. We can do things cheaper and better than another country. And I mean, it's just like kind of the math and the science, economics, and what's right, human freedom, commerce. You should be able to trade with whoever you want to.
There are specific things like national security. Maybe you want, maybe there's important specific industry, but blanket things, I just don't understand it. Maybe someone reach in the comments and type out that comment about what I'm not getting about tariffs. But
the idea, I mean, I hear, what's his name? Jeremy Lighthouse, Lighthouser. He thinks that we can generate a lot of revenue, and I still wouldn't buy it because it's still economic warfare. Is that if you can eliminate taxes, if you can replace the income tax with tariffs, I think that's an interesting concept to like research and study. I still don't like but I also don't like the income tax either. So like, tariffs are no good. But like, if you have, which is worse, I prefer some sort of like sales tax.
I forget if I was talking to you or Blake about it, but like maybe they did a study of, it was a single tariff on like fridges or something that Obama did from like 2009 to 2012, and basically the producers ate like 60%. Or either no, I think 60% of that tax of the tariff was passed through to the customer. So they ate maybe 40%, and maybe even more generously. You could say even if they eat even more than that, that means the cost of goods is going to go up a lot more than inflation is right now. Yeah. So that's a little bit, but we're jumping to conclusions that may not even happen. I just think that this general uncertainty is not so useful.
I agree, and you have to. You got to just focus on I've mentioned. You got to focus on the things you can control.
Yeah.
Be aware of the things that will affect you, but really don't only worry about the things that you can have an impact on.
And multifamily investments, to kind of loop that back, they are a long-term investment, and it's hard to see any of the kind of current things as long-term trends, especially so early into the administration.
Yeah. So, yeah. Very, very true. And I mean, again, net, worst case scenario, between tariffs and immigration, if cost of building materials goes up, that means value goes up, because it's more expensive to build these things. So it's bad for the industry in the housing crisis. It makes the housing crisis worse because we're going to build less housing. If you own a bunch of housing, it's technically good because it's worth more money.
Yeah.
But even owners of housing, we want there to be more housing.
Yep.
So
yep.
it's kind of good. It's good for everybody. But then the immigration thing, again, who's going to build the stuff if people aren't coming in? Who we don't have the domestic labor force to do all this work. We just doesn't exist. And then population growth, which we've looked at multiple studies. And if you turn immigration off, basically the United States goes from like slightly positive population growth to like flat or negative population growth.
Yeah.
And that's not just, again, from an economic standpoint and like growth of a country, like you want to be growing, you want to be declining, you don't want to be receding.
I reread a 2022 research article from NMHC about regulation costs for the typical apartment project. It was like 41%-ish total cost because of all these regulations and the tests and stuff. And I know that's one of his pushes. Maybe is like deregulating a little bit.
Yeah.
I wonder how
it's the
how
local
many...
stuff. That's what's tricky about that is
right.
so many of those regulations. Not all, but many of them are at a state and local level. And that's general why housing reform is difficult because it's not like the federal government or the state that's saying you can't build that apartment complex or that building or that warehouse. It's the local like zoning board.
Well, and
we want to have autonomy. We don't want the federal government to be able to come in and say you have to build this here anymore.
Or that's like letting them build. Like, actually, I would be fine with some regulations that say like you got to test the dirt and make sure it's not going to sink into the ground like a swamp or something like that, or for contaminants or whatever. Like there are certain things that are like, all right, I get it. It would be very interesting to dig into some of the specifics and see, all right, this is really unnecessary, this is necessary, and because even just the breakdown that they had in NMHC, it seemed like wow, it's just a little bit here, a little bit there, and all of a sudden you're at 40% more.
Well, Jay Parsons made a post on LinkedIn a couple weeks ago that I think we mentioned of the last Biden administration made a big thing on we're going to fight junk fees in the apartment industry, and like all these junk fees, and I'm like like there are some people that charge really dumb fees. Some fees like kind of have to like make the money back somewhere, and charging is a fee. So, but like what about the junk fee? Like if you want to actually get to the root of it, what is making housing more expensive? It's not the $15 technology fee or the $50 technology fee that you're getting internet cable for and everything else. It's the $20,000 fee here, the $10,000 survey that you have to do there. It's all of it's the hundreds of thousands of dollars or thousands of dollars per unit that adds up that makes the overall project more expensive, which requires the overall rent to have to be high.
Yeah, I wonder all junk fee or not junk fee, it's just that seems a lot like psychological. It's like the airline fees too. It's like, all right, how are you communicating? And I get it, like you don't want to be deceptive, but it's still like, all right, is it expensive to rent this or not? Fees included or fees not included.
Well, and it's who's going to be like the arbitrator of all this stuff, because there are times where it's like, look, to deliver this good or service, like if the cost of that goes up for a variety of reasons, the raw materials increase, the labor increases, what the inputs increase
exactly.
That, maybe a new regulation.
Here I'm thinking,
so sometimes it's like I can choose to raise. It's a choice of, do I raise the overall price and just have one price, or do I try to say I'm going to keep my price the same, but I'm going to tack on, like I have to make up for this additional cost. I'm just going to tack on a fee to try to do that, and it's like net the same.
Do you ever have like a? I'm just thinking of what are junk fees that some people have that other people don't. Like if you have a pet. If you have a pet and maybe you don't, or maybe
again, in apartments. So the fees, so like typical fees at an apartment, I'm going to go rent an apartment, would be like an application fee.
Oh no, I guess you got to do that. Yeah, you have to pay for that. Wait, for even just for like filling it out.
An application.
Oh man. Okay, all right.
Yeah.
You pay the fee even if you don't get it though.
Yeah.
I had no idea.
It's like $20, $25 usually. for an application fee. And that's like been standard in the industry for decades.
Feel like an idiot. I didn't even know that.
That's okay.
All right.
You haven't run an apartment for a minute.
Yeah,
And you haven't
yeah.
leased an apartment for a minute. That's
Yeah.
okay. You're dealing with the big
Okay,
issues.
application fee, and then like cable is that one? Because you could save people money if you buy it in blocks, right?
Yeah,
Okay.
you can, but some people don't. Some people don't like that because they really want to choose their internet.
Yeah.
But yeah, so that's another thing. So like we can do bulk internet where we go into a deal with like a internet service provider, and that's where like we are basically buying it. If you were an individual to go get that internet package, it would be $90, $120. We're getting it for like $45, and then we're typically charging residents like a total of $50. So we're making like $5 on it. But it's a win-win for the resident. Some folks don't like that, but sometimes that bulk internet gets wrapped into maybe like there's like fob access, and so you get fobs and and so it's all wrapped and to manage all of those systems, just to break it down for everybody, if you want to have like a controlled access system, the apartment community is being charged per unit for using that system on a subscription base. And so for us to offer the service, you're adding like 4 different fees onto it, or you loop it all into like a technology fee. So you get your internet and you go all this stuff. And then utilities, so there can be, you're getting, depending on how things are built, like water and sewer typically can be often done through RUBS. And so like the building's just getting a water and sewer bill, and then that's broken out by like the units that are occupied. Sometimes by usage, sometimes by, 2 bedrooms get X, 1 bedrooms get Y. And then, the electricity often is sub-metered, so you're paying that directly.
Okay.
Sometimes it's done through RUBS. But then there's also like trash. So like trash, we have to pay for the trash. And so some people don't like paying for trash, but it's like we have to pay somebody to take the trash away. And then oftentimes, especially in newer communities, there's trash services like a valet trash or valet living. There's different companies that do it, where you basically have a dedicated 5-ish gallon little like trash can, and you put it outside your door, and there's someone that physically comes through and picks up everybody's trash and hauls it away to the compactor. That's a service that we typically are charged, call it $15 to $20 for, and then we're charging like $25 to residents. So like, there's maybe $5 of like maybe profit there for or margin for providing that service. But the perception is it's like, why am I'm paying my rent? Why do I have to pay for trash? Why do I have to pay for this? Why do I have to pay for that? And it's because the industry generally has decided to break those things out.
It's just like it's a psychological thing.
It's all because if you're searching for an apartment, if you added all of that together, now your rent's $2,000, where before all the fees it was $1,800, and then so your competition is just going to break all those fees out, and they're going to list on apartments.com $1,800, and no one ever lives at your apartment community.
So and I wonder, if they pass this junk fee law or something, they just move it to the rent side, and then
everyone used free TV.
You get a nice little breakdown now.
Utilities included. That was for back in the day. That was great, and it was simple, but it was all baked into the rent.
And sometimes about the utilities included, you're like, well, how much of this rent is utilities? It's like there's a little bonus of like, all right, well,
you'll pay a little bit more, but then you don't really know, or at least it's broken out. So. Yeah, we've had a discussion on junk fees.
Well, and
fees. How it works.
I think that is
security
interesting.
deposit. There's pet fees. You got to put, because pets can cause damage. So you usually have to put typically it's like sometimes it's a deposit, or you just have to make a payment. Here's like a couple $100 up to $800 or even a month's rent, and then it's typically $25 to $50 per month per pet.
Okay, we're gonna be looking for those.
And we're gonna be looking for those. Yeah, who's got pets, but there's no pets on the lease.
Take pictures of chinchillas, maybe hiding in the
because
rafters.
the resident, one of the most common complaints is people don't pick up after their pets. Go to the bathroom outside, and we've got all these dogs, and it's like, oh, we don't have them on the books, and it takes time and energy and effort to not just fix up an apartment after like a pet has like destroyed it. Sometimes they don't always, but
it's a responsibility.
A
a pet is a responsibility, just like straight up, and you should own up to it. There's a whatever.
But there's also a cost associated with it, and it adds it adds risk
Totally,
to the
yeah.
site.
I also think if you're looking for someone hiding a pet, especially if it's a dog, if you just open a single slice of crafts, like a craft singles, the plastic there is like it's like a dog whistle.
You just need the plastic. Yeah, you just crunkle the
and
plastic.
then those dogs will come right to you. So
No hiding.
That's funny.
Tip, tricks of the trade.
yeah. That's funny.
All right, so so let's go back. Let's talk about. We'll see our investors adopt a higher rates.
So this is the section that we're heading into here is I said real progress or if we're in Groundhog Day, how do we get back to the next day? If we're repeating every day, just like Bill Murray was, what is the secret sauce to get you to move forward? And I think Marcus and Millichap lays it out. You kind of have to accept things as they are. And Globe Street is saying, people are starting to accept things. People are starting to move forward. Maybe a little bit different than the lesson that Bill Murray learned, which I think once he started helping every single person in that town, then he can move forward.
So we have to just accept higher rates.
And
lower price, like maybe lower prices.
Yeah, well, that kind of seems like it. Yeah,
sellers need to accept some lower prices.
That's what I think is more clearly made in the Globe Street article, less clearly in the Marcus and Millichap, but it's still the implication is there in both.
Well, I would agree wholeheartedly, and that was another sentiment from NMHC. Not necessarily, and this is where I'm starting to see a bifurcation, and it's healthy, and it's needed to happen for almost a decade.
Yeah,
because for so long. A-class properties, newer construction, traded in, you could 5 cap to mid 5 cap, and this is when interest rates were higher. There was always a premium on the new stuff. You're going to pay up for it. If you want something nice and new, less headache, and a great location, you could buy it, but you're going to pay up for it. But then over time, the Class B and C stuff, because the value add strategy was the talk of the town and the most preferred investment strategy, those prices started going up, but the cap rates were going down because they were being priced in with upside baked in. So no longer were you buying really on T12. You weren't getting it went from you were buying a 7 cap on T12 for like a C class workforce housing deal to where you're buying a 7 place on pro forma for a C-class deal. So they're like, oh, you're still buying a 7 cap, but on the T12, it's actually a 5.5 cap. And the broker is saying, well, you're going to go in and you're going to do all this work and you're going to raise the rents and you're going to make a lot of money. And so it'll be an in place, 7 cap or 7% yield on cost by the end of the year. And so you're projecting. And
this is what I always make fun of. Like, there should be a section of every broker's brochure. It's like, well, what if here's what if you found gold or oil on the property? It's actually a 12 cap.
They might as well. They basically have. I've seen, like, you could build more units. It's like, are you going to build more units? Why didn't they build more units? Tell me that. Why didn't they do that if it was such a good idea?
Yeah. So the dream is kind of the dream of.
So they were selling the dream, and so the spread between A class and C class, just as the extremes started to narrow, especially the B class. Then all of a sudden, I really started experiencing like 2018, 2019. All of a sudden, like the call it A- stuff was trading for like the same cap rates as like the B and C stuff. And so like all of a sudden you're like, well, why would I take on this risk for some maybe potential upside when I could go into maybe a sure thing and get the same in-place yield? And oh, by the way, there's actually still some potential to increase rents on some of these newer deals anyway, and so I can get a similar type of lift. If I can increase the rents on the old property, by X dollars, I might be able to do something similar on the newer property. Maybe by not the same extent, but I also don't have to throw in $15,000 per unit to fix up the older property. I can do the older property and replace all the roofs and re-tenant the property because it's got a horrible crime problem or reputation or all of the headaches. We started scratching our heads and we're like, well, that's when we started buying newer stuff, and it wasn't brand new because we couldn't get it wrap our heads around some of those prices at the time that we started buying instead of stuff that was built in the 60s and 70s.
Yeah.
We started buying stuff that was built in the 80s and 90s, and then early 2000s, and then mid 2010s, because I saw value add deals, old deals in 2022 that were trading for 4.5 caps.
Yeah.
Old deals that were trading for like just below replacement cost of a new property. It made no sense. So if you're basically going to pay $150,000 for something that was built 50 years ago and almost falling apart, or I could pay $170,000 or $180,000 for basically a brand new property in a better location.
Yeah.
Like, what am I going to do?
Yeah.
So that's where, the strategy that I heard most buyers prefer at NMHC is they're looking for relatively newer stuff. Because by the way, insurance on the older stuff has gone way up over the last couple of years. It's almost uninsurable. It's harder to manage. So what needs to happen is that spread needs to revert back to being a healthy spread cap rate spread between C class and A class. And the catalyst for that, I think, is these loan maturities.
Yep.
Because there's a huge concentration of folks that have bought these older properties with value add business plans that, well, they've got loan maturity. They took out short-term bridge loans, and they've been extended, pretended, and a lot of them are expiring at the end of this year.
Yeah.
And there's no bid right now.
Yeah.
And so the market has to hit a price for the market to clear. And so Class A stuff, there's still a lot of competition. Everyone still wants that. It's going to be in demand because that's what renters want too. So buyers want what renters want. It's just, people are having a hard time finding it. There's so little of it out there. But if you can buy, I made it, and I think I made a post on LinkedIn, got like 17,000 impressions. Like, it was crazy. And we're not even looking at like C-class stuff at all.
Yeah.
But I'm like, the contrarian play is to be going after these older deals that are going to be hard to manage. They're going to be a headache. But if you can get 8+% cash on cash returns, you can get 20+% IRRs, and like they're cash cows like they were when I started doing this 2015, 2016. Like that makes sense as an investment thesis. But that's got to clear first, and those prices need to come down. I don't see the A class stuff coming down that much.
And this is another article that we may not have time to discuss, but the clear quote here is, in December 2024, 38.13 billion of CMBS loans were classified as delinquent. That's up 41% from the start of 2024, and the delinquency of multifamily loans jumped by nearly 75%. So it is now at 2.77 billion, and this is not reflective of the entire universe of multifamily loans, but I think that increase in 75% in a year. And even though, yes, let's factor in base effects too, but we're at 2.77 billion. So for whatever the base effect that gave us that number, it's a problem that has increased significantly. There's kind of no way around it. I don't think that this is like a little bit of a volatility blip. I think that there's something that's been building, and it's something that is almost building a little bit in the single family space too. Last week, Blake and I spoke about a Freddie Mac. They were tracking these FHA delinquencies along with other delinquencies, and I think it was a lot of it was single family, but they had bottomed out, and now they're slowly starting to increase.
That's interesting.
Yeah.
With unemployment being low and so many borrowers locked in low rates.
It's not in a worrisome thing.
Is it gone from like 0.1?
It's just
0.01
It's starting
0.02.
It's like unambiguously like increasing. Now, I think that this story is much different in the single family space than in but it's very interesting to see that the pressure is starting to come to the home buying and home selling market.
Wow, it's almost like we put out a report on loan maturities 2 years ago.
Yeah.
Was that 2 years ago? A year and a half ago?
You got to be right, and you got to be right.
And then we put out another one this year.
Yeah.
Everyone, and then like a year ago, everyone's like, "Nothing really happened with these loan maturities." It's like, well, if you read the report, it's like it could easily be extended, pretended, and that's what happened. And then we did an update report that said these have been extended, pretended. Watch out for the end of 2025, and then look now.
Well, and that's what I was kind of wanted to ask you is, how much of a question were people ignoring that at MHC? Were they saying
no?
Boy who cried wolf.
No. I had a meeting with Arbor Realty Trust, and they famously, you can read about it all online. They've got a lot of bridge loans, and I mean, they said that they'd certainly been working with borrowers, a lot of extending, pretending that according to them, all is good.
Yeah.
They shut, they kind of closed up their bridge product for a minute. They've opened it back up. They're doing bridge debt again. No, but a lot of people were talking about it as a major factor. At the strategies conference, economists talked about it. Everyone was talking about loan maturities of just like a fact of life at the end of this year. And, I was like, I am familiar. Yeah.
Yeah.
I
Some
know
of this,
about
so this is a TREP document that we're looking at right now. They're really putting at the end of their period of worry about loan maturities at the end of 2026.
Yeah.
They're saying for the entire commercial mortgage universe faces the maturity of an estimated 1.78 trillion in loans by 2026. Now, I liked that word universe. And I was like, well, I kind of noticed it because he says the universe of CMBS loans. And I was like, do I ever use the word universe? And I looked through all my past notes, and the only place was when I was citing an earlier TREP article. So TREP really likes to talk about the universe of loans. That's all my thing. It's the little things. Sorry. We can get back to the serious stuff.
It's those details that certainly matter.
Little color.
1.78 trillion. That's a lot.
Yeah.
Yeah.
It is a whole universe, man. That's a lot. And
Almost double the deficit of the United States of the federal government right now.
Yeah, I think it will be a factor, and it will be interesting to see if we start hearing about
our interest payments. I think our interest payments right now, I think, are $1 trillion a year, which is basically like an Iraq war.
Yeah. Well, if we lower that interest rate, we'll talk to Jay Powell and make it a little easier. But yeah, the size of this. But also, we've mentioned that there may be select opportunities that come up where people are, forced to sell or something. I think that there's probably a greater likelihood of banks not extending and pretending again, and maybe we'll see people that make that decision. Like,
I don't know. I thought so because it was if rates were going to be lower, then people were like, look, you don't have any excuses anymore. If you haven't been able to figure this out, you're just sorry. This is just business. But now, it's almost like lenders are. Man, it's like, hey, you can't control interest rates. Neither can we. Like, not your fault.
Yeah.
Still like you. I could see them giving maybe some borrowers another shot. That would not like you can't shock me anymore with that type of stuff.
That's true.
But a lot of the conversation of NMHC was though that there probably would be some forced selling and that not all borrowers were going to get that an additional life raft.
I was and I think this is part of what we were talking, Blake and I were speaking about, and Blake was mentioned how sometimes he's talking to investors and they're like, sorry, I'm paying for this other deal that there's just a capital call. And that's kind of a bummer.
I mean, it's great. It makes us feel good.
Yeah.
It's not good, but we're getting a lot, and I've had investor calls today. I'll have more throughout, all this week. We're getting a lot of, you guys are doing great. Of all the sponsors that I'm with, you guys are performing, you're reporting, you're distributing, and you haven't issued any capital calls. And then, but if for our LPs that invest in a lot of syndicators, I don't know if I've talked to any of them that aren't dealing with a capital call. Yeah. Like, it's not just they heard of somebody with a capital call. It's like they've all got capital calls that are being issued. And again, we try to do the right thing. We try to do a good job. But I'm like, no, we're not doing it. I'm proud of the position that we're in for not being distressed, but it's a major issue. A lot of folks are earmarking capital of trying to have them put into deals, and we're having conversations with folks, which it's not really awkward. It's just a little bit awkward, but it's sensitive because you've invested in that deal. It's not just that deal. Again, people don't just invest in deals. They invest in or with people. Yep. And so this was someone that they believed in, that they trusted. Yeah. And so there's a lot of self-reflection that goes on of is it them? Is it me?
Yeah.
Like
No one wants
they
to admit
messed
that
up,
they've
but
been
like
hacked.
I believed them.
Yeah.
I made the investment. I had the opportunity to do due diligence. I didn't think interest rates were going to rise to where they were going to rise. And you don't want to just like, in a sense, maybe feel like you're burning a bridge, or you're not supporting someone anymore. And they're saying, I need help. We're in trouble.
Yeah.
Help, and also make sure you don't lose your money.
Yeah.
And then you have to make the hard decision of what's the probability of actually getting any of that money back? Because sometimes it's pretty low. Sometimes it's strong. It's high.
Yeah.
There's a clear path to success, and literally we need to bridge from A
Would it make you more money?
to B.
Just put it into that old deal, or
But then
put it in a new deal.
But then that's the thing. It's not it's not binary. It's not depending on the operating agreement. Different operating agreements can be more forceful, but it's usually you can either fulfill the capital call, you send your money in, you re-up. Oftentimes it's limited to a certain amount relative to what you invested, but not always. You can decide to not do the capital call. You can do you can do a portion. And it doesn't mean that just because you don't do the capital call doesn't mean you don't believe in the deal. And this is where like the nuance in the conversation comes in.
Yeah.
And I've done this. I've in the past been an LP in a deal, needed a capital call, and I had a partner, family member, we're invested together as LPs. And I believed more or less in the business plan. I was a little skeptical, but I thought it was possible. But collectively, the rest of the group, we decided that a lot of things have to happen for this to really work out.
Yeah.
And if we didn't do anything, we would be diluted. So if you don't meet your capital call, more equity gets in, your percentage of ownership goes down. Like, we get diluted, but it's not like we're out of the deal.
Yeah.
And it's not like they needed 50% more equity. So it's like we were being diluted just like a little bit versus putting in more money where we could lose all of it. And we decided not to do that capital call. And in retrospect, we should have done it. We could have done the capital call and we would have made more money. We didn't do it, and we still made money.
Yeah.
We got our money back. We actually made some money, and the dilution wasn't that bad, and still have a good relationship with the sponsor.
Yeah.
And so they think they understand, but it still doesn't make them feel good.
Yeah.
And it can just be awkward.
Well,
it's all about relationships.
And
so.
I am thinking about that at the same time. I'm thinking about we were looking over advertisements for some multifamily syndications yesterday, and the promises that they made were incredible. The numbers that you can put on 20-30% IRR if you want. You can put on that.
Yeah.
That's our projections. That's what we project. You can put 12% cash on cash. Sure. That's what I think. I'm an optimistic guy though, so but I think it.
I know. Well, yeah. There's a lot of like average annual return being used instead of IRR and some IRR. And so we haven't done a ton of really any Instagram advertising. We've done Google ad advertising for our deals in the past and research stuff. And we were just, I wanted to see what other people are doing. So I clicked on one ad for a syndicated deal. And there's a decent amount on there. And so then of course Instagram, that's all they're showing me is syndicated deals. So if you want to see,
good idea.
I'm not saying they're good deals, but if you want to see some deal flow of maybe questionable deals, click on just one ad and then you'll get fed all of them. But yet the returns, a lot of them were like, I'm just telling you, if you do that, you see a great capital ad, we're not going to show that high a number. We're going to show you, we've got a deal to credit, only open for accredited investors. It's like
remember
15.8% IRR. We got people that are like 25, 30% IRR, 30% preferred return.
Yeah.
What does that even mean?
And so maybe this is kind of maybe why they have this accredited investor rule. I don't know, but let's say you didn't know, and that's why it really is your responsibility to know the lay of the land, even when it comes to just these like basic numbers, not just like the assumptions they use, but like, all right, is this really realistic? 30% IRR, or is this really realistic? 3x your money in 5 years? Like that's.
I don't know how. even if like we had a deal that showed 30% IRR, I think I would be concerned that it would it would just like it's too good to be true.
Yeah.
And that it's not serious. And I would like find a way to discount it to make it like seem like more realistic. Or to me, it's usually when you see a number like that, it's like there's something is missing.
Yeah.
Like we didn't. Oh yeah, we're assuming we're not paying any property taxes because we have some assumption.
Yeah, yeah.
Or
That's
something.
but that's what I think about when I
Yeah.
think about capital calls, or maybe a deal didn't go as well. Well, there's risk and return, and if you're promising these hugely high returns, what happens when there's risk? As well, maybe you're going to be.
Yeah, and especially today because like again we're talking about maybe for selling, but like the distress is so pocketed right now that it's not like there's like a fire sale going on anywhere. New Class A deals are still going for sub 5 cap rates, or around 5 caps. So if you see something that's too good to be true in today's market, it probably is, because it's not an easy market to make deals work. I mean, the only way that we're making the deal that we have going right now work. Well, it's not the only way, but it certainly helps. Is we're assuming a fixed rate loan that still has 5 years of term left on it in interest only, at a rate that's like a whole percentage point less than we could get today.
Yeah.
At leverage that's like 68%. So like similar leverage,
And-
better rate. Otherwise, the deal would not look nearly as attractive.
And Blake made a good point. I definitely conceded to him last week when it was like, and I think this dovetails into our conversation here about like, all right, just getting used to the higher rates and accepting things. Is don't let your whole business plan be dependent on where the interest rates are, or an interest rate moving lower than it currently is. You just have to kind of deal with these difficulties as they come, and operate it good. And if it works with the current interest rate, then you're good. But don't bet your money on it going down.
Yeah, and even if it's like, oh, we need it to come down a little bit, and it's and like, I mean, maybe
It's up, it's going up.
but it could go the other way.
Yeah.
And yeah, you can't assume that things get any better. You have to assume they get a little bit worse. And it's okay to say, but if things got better, then this. But that can't be a base case. That has to be a upside that I'm kind of not even looking at a little bit. So.
Yeah. So do you want to talk about our latest deal?
Yeah, I'm excited about it.
All right.
Yeah. Well, we're officially under contract now.
Nice.
So I can actually talk about it.
I know.
I
This
can
is
actually
a
talk
load
about it.
off. Yeah.
Oh my gosh. Yeah, we've been hinting at it for a while. And the exciting thing is that we've got call it 70-80% of the capital raised right now. So we've got a lot of interest from a lot of our existing investors who've been waiting for a deal.
Yeah.
But it's a 2020 construction. Did you say you have the deck, or is it just the landing page?
it's the
That's
HubSpot
next one.
Yeah.
And just, disclaimer, only open for accredited investors only, because the SEC doesn't want you to spend your money the way you want to. But 2020 construction, beautiful property. It's located in Jeffersonville, Indiana. A lot of folks aren't familiar with Jeffersonville, Indiana. Jeffersonville it's essentially, I'm assuming here, and you can get this whole deck by going to walcottinvest.com or greatcapitalllc.com/Walcott. But walcottinvest.com, you can get this whole deck and schedule a meeting with us and all that fun stuff. But the market is really dynamic and interesting. So it's basically a suburb of Louisville. It's right across the river. I think we got a map here somewhere, don't we? Yeah, there we go. So we got downtown Louisville, which Louisville is like top rent growth market, Q3 2024, one of the top rent growth markets of 2024 in general. Right across the Ohio River is this Clark County, and this in the city of Jeffersonville. There's a couple other little area like cities right around here, like New Albany, Sellersburg, and it had been old kind of industrial manufacturing town from the beginnings. It was founded in the mid 1800s, building steamships. Like the Union Army had a major outpost here during the Civil War. So a lot of interesting history. Has been able to adapt economically over the times. Adapted from heavy manufacturing to more education and advanced manufacturing, healthcare, and it's been exploding in the last 15 years because they a couple things, but one, they have this public private partnership and created this River Ridge Commerce Center, which has created like 15,000 jobs. And for every 2 jobs that are created in Clark County, but in Jeffersonville, every 2 jobs that are created, they need 1 new unit of housing.
Yeah.
So they basically need like 7,500 new housing units.
Wow.
But the problem is that they built a couple thousand.
Yeah.
And at the same time, Louisville is like a flat population growth. Folks are moving from Louisville over to Jeffersonville.
Well, Louisville there was a couple months in 2024 where Louisville was the top rent growth in the nation.
Louisville's you have to be specific of where you invest in Louisville. The east side is better than the west side. It's much more pocketed. But Louisville, but from a multifamily market, they did have a lot of supply, but they have seen a lot of rent growth.
Yeah.
But generally, Jeffersonville the demographics are trending in a really positive direction, where Louisville generally is kind of flat.
Jeffersonville is one of the top for like communities above a certain amount, and like 40,000, I think. Jeffersonville is one of the top growth. Like it beats out Carmel and stuff, and other fast
just like in
areas.
Indiana, it's fast. It's right behind Hamilton County.
Yeah. Okay.
And so a lot of advanced manufacturing jobs, tech jobs. Huge data. Meta is building a data center. There's like a multi-billion-dollar solar panel.
Look at that! There you got the water and the power right there.
Exactly. It's all right there. And so they haven't built enough apartments over the last couple of years. They built a decent amount in the last 2 years that they're getting absorbed at a very high rate. The market's still growing at like 4% rent growth, even with like they're hitting like peak supply that more than they've ever seen. But where it's located is really cool because there's a walking bridge. It used to be a rail bridge, and 10 years ago they converted it to a walking trail, and that it's called the Big Four Bridge. You can see right here. You can ride your bike over it, and it starts at a park and basically outside of downtown Louisville, and it terminates at the Memorial Park, which is right on the doorsteps of the Walcott. And so basically you walk out. I'll go to this picture up here, and if you're just listening, you can watch the video on YouTube, and you can follow along or go to walcottinvest.com and learn more. But see this green space out here? This is the front of Walcott. This is the beginning of the park, and the bridge basically terminates just a little bit further south. And so it's unbelievably connected. You can get to downtown Louisville, but also you're right in downtown Jeffersonville also. It's right next to the dining, the shopping, and all of that. So great location, like A+ location, really good market. It's about an hour away from our headquarters in Indianapolis. We self-manage. It's easy to get down there. We're buying at a great price, really good basis, $182,000 per unit, which is below replacement cost. There's a deal being built in the market right now in Jeffersonville. Talk to the developer. They're delivering for like $230,000 per unit. So that's like a $50K unit difference. And I mean, it was built in 2020, so it's 5 years older, but it basically built the same specs. Low fees, kind of our standard fees, $100,000 minimum investment. Returns, I think they look solid. 6% average cash flow. It's a 5-year hold period, and so over 5 years, the goal is to double your money. Basically, get a 2x equity multiple over the 5 years. That's what underwriting is showing, and the IRR, the internal rate of return, net of fees and promote and all that stuff is basically 15.7% over 5 years, and that's using an assumption of a 5.5 cap exit. Yeah. So, which I think is for this type of deal, I'm not seeing any deals trade.
It's interesting. It's interesting what you said about B class and C class earlier about everyone. There was a phase, I guess, or a fashion, a trend where people were really wanting to fix up these older units, and there's a lot of risks, a lot of question marks, and the amount of risks. It's not just like a number. It's like, no, suddenly the pipes aren't working. Oh, suddenly there's like water everywhere, or suddenly like there's so many things.
Yeah, and it's not one thing. It's like the whole thing.
Yeah, it's like the whole thing that will happen. And up there, you're giving your numbers. There's, I feel like there's more chance for things to go wrong on a value add.
Oh yeah.
Than there is on
now. Plus. 100% right. Now, that doesn't mean you don't do your due diligence and don't ignore things, because on new construction, you want to make sure that it was built right and the materials are quality,
Okay.
and they were installed correctly, because it can be new, but if it's installed the wrong way, or if it's like a poor, inferior product, like, you're going to pay for that eventually. So you need to catch all that. But once, assuming that what you're buying is a quality product, there's a lot less moving parts. There's not a big renovation project to manage. That's a whole other element to itself. Now, you still have to have a business plan. You have to have an idea of how you're going to grow rents, and it can be a combination of, like, all right, there is some organic rent growth in the market, but that's not usually going to be enough to, like, get a decent return.
Yeah.
The current owner, they're based out of Florida. We're basically based out of down the road, just up in Indianapolis. We manage the vast majority of our properties in the state of Indiana, and we've had a proven track record of taking newer properties that have been doing decently well and accelerate it from lowering some expenses. Like, their payroll is really high because they're out of state. And we see a real clear path to be able to add some value, doing some, calling it, ultralight value projects. And so, we experiment. We're going to go into some units, do some ultra premium upgrades. And so, getting back to the whole idea of selling the dream, we're still hoping. I think that we can still sell the dream. The business plan's not required. Doesn't really. It's not even factored in the business plan. But we're going to renovate 5 units, really ultra premium finish level. So we're going to have even nicer countertop. Not like a accent paint, some new plumbing hardware, new cabinet hardware.
Put a TV in there.
Put a TV in there.
Give them a TV.
We don't. I mean, we can
put
give
it in
away
the
a TV.
unit, not give it away.
People can have a TV.
I would love to
You
not
want a
have to
microwave
move.
too?
Yeah, I true. I mean, I would love to not have to move my
microwave
TV,
come
but then
with
you're
it.
going to put it in storage anyway, so never mind.
Yeah, and I mean, it's not a bad idea. People used to give it TVs. If we're having a hard time leasing, maybe we'll give away a TV. But you can buy a TV for
I know.
$50 these
I'll
days.
have to tell you a story about my son getting angry the other day.
Oh, okay. But so the idea though is, if we can get like $150 rent premium on those, we in 5 years we can tell the brokers are going to sell it. That in their pro forma, be like, look, you knock out more of these upgrades, you're going to be able to achieve $150, plug that into your pro forma, and then you're going to sell on that dream. And so you can try to achieve a slightly lower cap rate.
You were talking about this when you were talking about when going after A- ones and upgrading theirs. It's a constant process.
Yeah.
By the end of those 5 years, we're gonna, that apartment's gonna be 10 years older than everything else. So you just have to keep it up.
And it seems counterintuitive to upgrade a new property, but when you are in a market that is seeing a lot of demand, and it really comes down to, if you can only truly do this if you're in a prime location.
Yeah.
And a place that is like downtown somewhere, or right near downtown, like Walcott, you can do it because there's people who just want to be right there. And they'll pay just about anything. They're not budget conscious. You can't do this for the whole community because people generally have budgets and are cost conscious. But if it's a top floor, it's the best unit in the building and nice finishes, $150 a month. That's like a decently nice dinner for these folks that they're probably already going to have.
Yeah.
And
kind of fun to tour it.
It's yeah. So we'll actually be down there tomorrow. So this episode will post. So unfortunately, I'm getting too late, but I'll be down there. We're going to be doing a webinar live on site.
We'll put the link to that webinar in the.
We're going to replay it. So make sure that you subscribe to the Great Capital YouTube channel so you can be alerted when we post all of that. It's going to be really, really critical. But it's going to be a lot of fun. We're going to be doing due diligence. We're going to walk every single unit. We're going to inspect everything. We've got contractors, inspectors, unit walkers. It's always a good time.
Oh, yeah.
And we'll learn more. If you'd like to schedule a meeting with me or the team to talk about this opportunity, again, you have to be a accredited investor. The minimum investment is $100,000 because we're raising $15 million. And do some math on how many folks I got to talk to at $25,000 a piece. There's not enough hours in the day. So minimum is $100,000. Schedule a meeting. Go to walcottinvest.com, and it'll either be myself, Blake, Griffin, and we'd love to have a conversation with you. And if it all makes sense, you can get access to our portal at greatcapitalllc.com. You can review all the deck. We've got due diligence materials. We have a whole deal room. You can go through basically everything that we're looking at. We're essentially an open book. And then you can not even talk to us and make your commitment. We've had people, we've had millions of dollars of people do that. I like talking to people to be like, who am I investing with?
Yeah.
But if you've been watching the Gray Report for the last 4.5 years and you're like,
Yep.
you guys aren't going anywhere.
Yeah.
You're still doing this. You're obviously a real company.
Yeah.
You know, we got an office. We actually have a portfolio.
Yeah.
Real people. You can
It's
go
not
right.
a fake background.
It's not a fake background.
We'll have some of the investor meetings.
open the door.
Some of the investor meetings happen in here, and when I tell the
it's true.
investors
It's
like
true.
we got to record, they're like, no, we need this room. I said put a background in, but they don't. It's the real thing.
Yeah, you can actually. We don't record the interviews, obviously, but we do use this room often. I don't. I'm sometimes in my office. Blake and Griffin are often in here, and it feels like you're on a podcast. So if you want to pretend like you're on the Gray Report, if you want to pretend like you're on a podcast, and you know, hey, if you want to invest, we'll bring you on the podcast. If that's what you want.
Hey, that would be interesting. I always thought that that's
I'd love to actually hear
important
people's
perspective for sure.
perspectives.
Yep.
Yeah. Well, that all being said, thank you for watching this great episode of the Gray Report, Matt. Thanks for keeping the lights on while I was in Vegas.
Anytime. Blake, thanks to Blake.
Blake did a good job. Yep. Blake's a rock star. Did Blake doesn't tell anybody?
I didn't tell anyone.
Did he tell anybody?
No.
On the last episode?
No, because that's not. I introduced him as the head of investor relations at Gray Capital. I didn't say he's a sports hero that we all look up to.
The man he's an American hero. Blake he's our head of Blake Prone. He's the head of investor relations here at Gray Capital. He's a very modest fellow, and where others would use what he's got, and try to leverage it, he wants to be known only for his work on real estate. Yep. But he has 4 Olympic gold medals. He retired in swimming.
Yep.
He retired from swimming after winning. And maybe he's got 5. I think when he won 3, he's won
count.
3 gold medals. He's won 4 gold medals, and then he retired from swimming. He's like, I want to go all in on real estate. He's started working with Gray Capital. He's been crushing it. And then we didn't have a deal in like 2023, and he's like, he's like, I need a bigger challenge because he's just we don't have a bunch of money for him to go out and to raise. And so he's like, I'm just gonna see if I can go to the Olympics again. And he just did and won a silver medal, and he's incredible. But he doesn't like to talk. It's not that he doesn't like to talk about it. It's just he doesn't feel like it's necessary and not even relevant. Yeah. And I think it's a pretty good trait. But it's interesting because again, he'll be having conversation with investors, and I've seen people, business development people, use like. I tried out for the NFL. Like, you should talk to me. Or like, I played a season in the NFL, or I played football in college, and like that's on their
sales books on.
And that's on their like LinkedIn, like the headline of like what from a Division A fullback now to sales.
Here's 3 ways about how winning a gold medal in the Olympics is just like closing deals.
Yeah, and Blake's like, no, I don't think any of that makes any sense. But go watch that episode. Blake did a great job. And make sure you like and subscribe to the Gray Capital. This video, subscribe to Gray Capital YouTube channel. And we'll see you on the Walcott deal. WalcottInvest.com if you're an accredited investor. We'd love to partner with you. It should be fun. And catch you on all the other stuff.
Sweet.
All right. Thank you.